Well, welcome to the Mutual Fund Show. I'm Neeraj Shah. The next 25 minutes, we'll talk about MFs, but with an idea of what could one do in 2024. Now, 2023, viewers, was unequivocally in favor of equity mutual funds. And I'll tell you why. One, the returns that some of these funds gave, whether value funds, thematic funds, or multi-cap funds. Two, even in terms of inflows, cumulative inflows into equity mutual funds, far outstripped that into debt. Now, you could argue that's probably an annual phenomenon that might repeat every single year, but be that as it may, for 2023, that was certainly the case. The question to our two experts on the show today is that after such a banner year, particularly for the broader end of the spectrum, and therefore those kind of funds, and in fact, some funds underperformed the index as well, what could be expected in 2024 for somebody who wants to construct or reconstruct her or his mutual fund portfolio? To talk about that, Ruchi Sankhe, investment advisor at Infinity Investment Advisors, and Vishal Dhawan, founder and CEO of Plan Ahead Wealth Advisors, with me on the show. Both of you, thank you so much for taking the time out and being with us. And at the outset, Happy New Year to both of you.
Happy New Year to you too.
As well. Thank you so much. Ruchi, I'll start with you. Great year. Let's start off with the equity funds, because let's bifurcate it to equity, debt, and then kind of the other asset classes as well. Great year for people who invested into equities through funds. What should one do to maximize equity fund returns in 2024 or over the next 24 months?
Okay. I want to start a little bit with what's happening on the macro level and how you should construct your portfolio going forward, right? Because that will decide whether equity or debt or hybrids, what makes sense.
Sure.
So obviously everybody's talking about the global interest rates coming off, and that's going to have an impact on India as well. And we see that tapering starting to happen perhaps in the second half of the coming year. With Fed, you will start seeing probably 25 to 50 basis points reduction, and then you will also start seeing something following the lead here in India as well. With that happening today, where we stand, in fact, interest rates are probably at the highest level, and we want to take advantage of that from the debt side. And from a debt side, I would construct a portfolio which would probably be a little bit more longer tenor on the GSEC side, and those would be the funds to play with today on the debt side. On the equity side, we've had a bumper year so far. And while caution is always advised when you come out of such a great year, I mean, you would have seen that the small cap index is up by almost 56%, and mid caps are up by 47%. In fact, even the regular index, Sensex and Nifty, are up between 20 to 24%. So we've had a very strong year. Where by coming on the back of such a year, you do expect muted returns. But having said that, India is still very strongly positioned as we go forward. And I would not go too underweight on equities even from here onwards. I do see the election year. In fact, now the outcomes are becoming more and more predictable in what might happen on the elections going forward. Having said that, and also the economy, in fact, JP Morgan recently released a report which said that they expect the GDP growth to be almost 7% for this year, which is reasonably strong when you consider the global environment, and even US currently at 2% projections. So you would continue to see flows coming into India on the equity side. The balance sheets are reasonably strong of the companies. There is lower leverage. We have seen interest in the services sector so far. We might see on the back of elections happening this year, fiscally induced capex kind of investments. So you will probably see those kind of investments going in. And that's why equity might still continue to perform this year. And I wouldn't go too underweight on equity. So equity funds make sense. You could construct your portfolio with some balanced or hybrid funds, which will give you an access to debt as well as equity. But I wouldn't say that let's go underweight on equity funds and just strongly go overweight on debt, which is what the common refrain is today on the street. Saying debt, you can see predictable returns, and equity is coming off a very strong year, so you probably will not see such strong returns. So I'm of the view that you would probably go a little bit underweight, because you may not get the 20% returns that you've seen last year, but still continue to build a equity portfolio with slight under allocation, and also go stronger on the debt funds. So that's how I would construct the portfolio, and also look at some alternates as we go forward. Alternates also make sense. Today, REITs are between 5 to 7%. InvITs and REITs are giving those kind of returns. And if the interest rates start to come off, you'll start seeing capital depreciation there also. Those are alternates to the listed equity funds as well. So those are the things that I would use to construct a portfolio as we go forward, with some allocation even to commodities like gold as we go forward. So that's how I would construct the portfolio.
Okay, and we'll try and remit the conversation on this show at least to how to do it via the fund route. So if the fund route, mutual fund route allows us, great. Otherwise, we'll kind of give it a pass. A lot of viewers tune in, especially to get advice purely from a fund perspective. But the point is well taken. Thankfully, Ruchi, out here, the markets team has not kind of gone out and heard too much about going underweight equities. If anything, everybody's saying it's still probably a year to reckon with when it comes to equities. Vishal, just wondering, when you are thinking of what to tell clients about how the mutual fund allocation in 2024 should be, is it still largely equities, or do you believe the predictability of debt, particularly both global and local funds coming rates coming off, might help that debt portfolios? Is that making a larger presence than 2023?
Most certainly. I think we do think that, at least as of now, because the risk obviously at the start of every year is, things can look very different a few months down the line.
Always does.
Always does, right? So so I think very clearly interest rate movements do seem to be trending downwards. Even oil prices, which was a big concern that existed a year back because of the big supply coming out of the US, seems to have handled itself really well. And therefore, you do think that fixed income could be a good place to be in. You could obviously look at some amount of accrual through short-term funds, and then of course some amount of duration coming in as well. And clearly there is now the option for you to buy into international funds doing debt as well. And therefore there could be a little bit of a play to try to lock into some of those yields overseas as well, and then maybe get some additional arbitrage through the rupee depreciation that traditionally happens against the US dollar. So clearly fixed income is a good place. Equities is good, but I think expectations of returns need to be much lower than what they were in 2023. Clearly there's a lot of excitement around small and mid caps. The flows into mutual funds are seeming to show that. I think that's an area where people need to be really careful. You spoke about multi-cap funds outperforming. Very clearly a large portion of that outperformance is coming from just the structure of those funds needing to have at least 50% of the allocation between those two. And of course they can go even higher. So I think the way we need to look at equities is be a little careful. That doesn't mean you make it zero, but be careful, and don't forget that in 2023 equities did well all over the world. US markets did really well, Japan did really well. So when you look at India in the context of what happened in the globe in 2023, India is actually a little bit of a middler in terms of performance. So I think you need to look at 2024 clearly as a year where you allocate to equity funds in India, equity funds internationally, some international debt, some India debt, and of course gold, because traditionally gold has done well when interest rates start to peak out.
Viewers, simply put, right? I don't think the message coming out here is that go underweight equities. If anything, both of them are saying, Ruchi in particular, that this is not the time to go underweight equities, but balance it out maybe, because if you expect the returns that came in 2023, especially at the SMIDs end, which is the small and mid caps, there, who knows, there might be a bit of a disappointment. So difficult to predict that. Now, I'll try and break this up into funds that have done well, because there's a bit of a recency bias in the minds of investors, just to try and understand what would you do with some of these which have done so well, because like it or not, people unfortunately sought mutual fund returns by the last 1 year, 3 years, look at the best performers and then tend to invest. So I just want to get that bogey out of the way, right? First up, Vishal, to you, the top 4 gainers in 2024 when I looked at equity mutual funds were value funds. Now, yes, value has made a comeback versus growth, save for the US, which is a different kettle of fish altogether, but we've seen value make a comeback. Is it safe to say that because the markets are so expensive and there might be a hunt for value, that you might still see value funds do well, or not necessarily the case? What would you do with your clients' money, existing or potential, into value funds?
So I think, again, as a style, it's a very broad style. I think one needs to go one layer below that and actually look at composition of those mutual fund portfolios and try to segregate out how much of that return has come from a certain market capitalization in the marketplace. So for example, if the value fund's done really well because it has a large small and mid cap tilt, or a significant small and mid cap tilt, then I think you need to be a little careful because everything in that space is probably expensive. But we clearly think that value funds that are large cap oriented, even though they have flexibility to go where they want, are a good choice and continue to be a good choice, because we do believe that when valuations are excessive, trying to get into value funds is a good strategy, even if it just controls downside risk at certain points. And then when recoveries happen, because the stocks that they held were not that expensive, you tend to do better because you fell less. So we clearly think value is a good place to go to, but look at the portfolio carefully and try to figure out whether returns came from small and mid cap or not.
Okay, so not asking for recommendations here, right? But if people want, because not too many people will have the ability or maybe even the time, right, at times, and people should have therefore an advisor or a portfolio manager to do this, Vishal. But what funds would fit this bill, where the exposure to these is not very large?
Yeah, so I think with the way information is now available on the internet, just getting market capitalization based portfolio breakups is quite simple.
Okay.
So try to look for places where you have anywhere between 75 to 90% in large caps. I think anything which is 10 to 25% in mid and small caps probably is fine. But that's the simplistic way to actually break it up and look at what and where to allocate money to as far as value funds are concerned.
Okay, Ruchi, you agree?
You may
disagree, by the way.
No, so I will tell you, I have a different sort of flavor to this. It's obvious, it's evident that value funds will do well when you come through an interest rate environment which is very high, because whenever interest rates are high, value does better than growth, because growth funds, and that's what you've seen actually globally, not just in India, but even globally you've seen value funds doing better. And that might continue because interest rates coming off is probably a phenomena happening in the second half of the year. So I would look at saying that, hey, don't get out. It's not that the story is over for value as yet. Value will probably continue to do well. So have a blend which is more balanced between value and growth. And so I would still have some value funds and I would add some growth funds as well. So you don't need to do it in the same fund. You could actually do different funds for growth and different for value, and then kind of create a portfolio which is more balanced and diversified, because in my view, value will still perform this year. So that's my view, saying that I wouldn't necessarily only look at the market capitalization, because there are different ways to look at that. I would look at what is the construct in terms of value fund and growth, and look at that. And I would actually not look at market capitalization when I'm looking at this. So a little bit different view than Vishal, because I would say that, hey, let's look at investing in pure value funds and pure growth funds and creating a diversified portfolio for both.
Okay, a viewer is listening to you right now, Ruchi. She wants to know, how does she do it? You've been doing it. How does she do it? What would you say? Analyzing.
Analyzing, yeah. I mean, basically you look at the Ps of the funds. You'd see there are certain funds which actually are positioned as value funds, without taking names, but many funds.
We love names, by the way. Actually, they're not recommendations, but I'm just saying. Yeah.
So let's say an ICICI Pru Discovery Fund is a value fund. So you know that you can incorporate that as a value fund in your portfolio. You could have growth funds, which will be, specifically registered as growth funds, which are looking at, larger cap, mid cap, small cap names, but which are looking at higher trajectory in terms of growth versus value. So, you would have a blend of an ICICI Discovery Value Fund, which is one fund that, you could incorporate in your portfolio, as well as some growth funds. And that's how you would construct the portfolio for an investor.
Multi-cap funds made their presence felt, and how? For all the brickbats that they got about how fixated 50% allocation to mid caps and small caps, and so many people saying that I won't want to do that, I'll do a large cap, mid cap, small cap fund separately. But the funds did well. Now, for somebody who doesn't have the time, she's listening in right now and wants to understand that after such a banner year, when everybody's saying that large caps is the place to be in, are multi-cap funds still viable? What would you say?
So they certainly are. I think there's a segment of people who just don't have the ability to identify a whole bunch of different funds and are looking for a single solution to be able to get different market cap access and still give the fund manager a little bit of flexibility, because that 25% large cap, 25% mid cap, 25% small cap can be supplemented with the balance 25% going wherever the fund manager wants. So that little bit of space is there, but I think you need to be very mindful that The reason why multi-cap funds have done so well as compared to other categories in 23 is there's a very large outperformance of mid and small caps this year. That difference is as much as about 30%. And obviously, if you have a very large outperformance, any fund which has at least 50% in mid and small cap is likely to show better outcomes than something which doesn't have it. And I think, therefore, you need to have a very clearly longer term horizon if you want to make money, if you want to go into a multi-cap fund, because there will be periods where you will either get no return from the mid and small cap segment, or you will actually have the risk of that mid and small cap segment giving away some of its gains. Because clearly, as you look at data right now, earnings estimates for mid and small caps are set at between 28 and 32%. And therefore, there isn't a lot of options to really get it wrong. Even if you do 20%, you're still in a bad place. So I think if you want to buy multi-cap funds, make sure that you're there for at least a 5 to 10 year investment horizon. Don't buy a multi-cap fund on the back of what happened last year and expect that to repeat out in the next 12 or 24 months, because you are buying into it with some amount of risk. Or alternatively, build it as a core part of your SIP portfolio, saying that I don't really care, things will go up and down, and I'm just buying long term.
So again, not recommendations, but I don't know if you're at liberty, the 1 or 2 funds where things might be on, they might not be the only ones, it's not an exhaustive list, but where is it that wherein you believe that your clients are safe putting in a long-term SIP in the multi-cap category?
So you could look at something like Nippon, for example, which has done fairly well. We do, of course, as an advisor, prefer certain other categories in this environment, like FlexiCap, which can, take away that forced sort of requirement to allocate to mid and small cap. And that's a space where there are, again, lots of good players, Parag Parikh, HDFC. I mean, some of those have done really well. But clearly, if you had to go to multi-cap saying, I want to go there, I'm okay with small and mid-cap allocations, then just ensure that you have a longer-term investment horizon.
It just doesn't surprise me that the name of PPFS comes up every single show, every single year as a flexi-cap recommendation. Just somehow they've been able to do so well. Ruchi, the other category, and we'll move places because I want to cover as much as we can, is thematic funds. Now, obviously, in a rising market, thematic funds would do well because there's a theme which will obviously do much better than the benchmarks, right? So it's a given. Can a similar thing happen in 2024 wherein certain thematic funds could do well? And if so, do you have a handle on what categories or what themes could actually do well? What is it that you might be recommending to your clients?
Right. Personally, I don't recommend thematic funds, but I know that there are certain themes that are positioned to do well as we go forward, and there are a lot of market participants who are sort of presenting some of these themes. So healthcare is being one of those funds, consumer, IT. A lot of these funds, which are sector-based funds, are being recommended. Personally, I feel that you can't really time your entry in and exit out of a sector. And if a sector is doing well, then you could actually play it out not just by being focused in that sector, but maybe having a concentrated strategy which will be outside the mutual fund route, right? So I would steer clear of thematic funds. But having said that, these are the themes that are positioned to do well. And if one is looking at making an investment, then one could look at IT or healthcare or consumer thematic funds. So.
Okay. In which case, Vishal, can I just quickly get you in? I mean, when I look at last year, for example, a PSU fund. In fact, the top 3 performers seem to be PSU equity, and a PAR and infra, which would have a large flair of PSUs as well. That seemed to dominate. Are you guys recommending thematic funds, or you are avoiding them as well?
So we also avoid them. But clearly, I think you're seeing that strong performance of PSUs show itself up in various places. So whether you look at infrastructure, whether you look at defense, I mean, a lot of these spaces have gained because PSUs have done as well as they have.
Yeah.
But clearly, we think that being a little more defensive on thematics may be a good idea for 2024. So, for example, pharma might be a better place as compared to the more aggressive sort of themes built on capex and a lot of other places.
But viewers, remember, if you want to get into thematics, and a lot of you are newer into the markets, please know that the risk horizon has to be higher. Maybe even the time horizon has to be higher, because the theme may not necessarily play out within a calendar year. I mean, so just keep that at the back of the mind. Now, to debt funds as well. And Ruchi, can I come to you? I heard you say at the start of the show that you are inclined to debt funds, but with a certain duration in mind. Can you tell us, again, for a viewer who's listening to it right now, she wants to know, how does she get into debt funds? What kind of funds with the time horizons that she may have? Let's assume she's an average risk investor, average age investor with an average income profile. What would you recommend?
Yeah, I mean, so I would again have a mix of short duration as well as medium duration funds. While I would say that, increasing duration today makes sense, but you do need to have a core portfolio as well. So it can't be just, so corporate debt funds are a good, GSEC funds are a good area to be in. And I would kind of balance it across different funds. So, so that's how I would construct the portfolio.
Okay, could you just explain this? I mean, what kind of returns can be anticipated this? And when you talk about, for the uninitiated, when you talk about the shorter duration, longer duration, what would it mean? Do they have to time it to the investment horizon that they have in mind, or to the horizon of the paper that the fund is holding? Can you just tell a bit about that?
So, I mean, when I say, so basically duration, meaning the way it's constructed, the papers that are constructed, the average maturity should be between 2 to 3 years, right? I mean, so that's how you would create a shorter duration fund. And longer duration funds, the average maturity would be such that, when you compute the duration basis, the maturity of the papers that they're holding, they could have 6-7 year paper, they could have to, 3 or 4 year paper. The average duration then comes to between 4 to 5 years. So that's how you would create the portfolio of the fund manager would create a portfolio. So when I say duration is effectively computing the maturities of the underlying, bond securities that they're holding and averaging that out to say that between 4 to 5 years, it would be a right duration to be at this point of time, basis how I'm looking at the markets and how interest rates are sort of moving as they move ahead, how interest rates will fall over the next 1 or 2 years. So that's what I was, that's
so that's a difficult task for an average investor. Better to have a portfolio advisor in such a case?
Yes, it's always good to have a portfolio advisor who could, suggest what kind of funds to invest in and, what kind of an allocation to have across these funds.
Got it. Okay, thanks. The final piece, and we have about 60 seconds left on the show, but I had heard you say that international debt could also be an option via the Indian mutual fund route. Quickly, can you talk about that? 60 seconds.
Yeah, so again, assuming that interest rates start to head down somewhere next year, we've already seen the start of it happen in the US. Assuming that they continue that journey, you will see possibly 2 things that you can take advantage of. One is, of course, just interest rates coming down, and you now have at least 3 or 4 different funds that you can take advantage of. And they also have different durations. So there are very short-term international debt funds. There are some which are sort of more medium duration. So you can choose to go to a combination of both of them, because this is not something that you may have used in the past, but it's got lots of usage, especially with Indian investors now spending overseas as well, education for children, travel, lots of those things have now come into play. And the second piece continues to be that over long periods of time, the rupee does tend to depreciate. So what you're trying to do is trying to leverage both the fact that interest rates could come down, and secondly, rupee depreciation tends to be most often the case, which ends up happening. So look at some of that. It's an interesting opportunity. Lots of options available. But again, it needs to be core in your portfolio. You can't just say that, I'm waiting for the interest rates to fall by 50, 75 basis points, let them fall, and then I will just exit and move back into something else. I think it needs to become core.
Got it. Okay. Well, both of you, thank you so much for taking the time out and being with us. And once again, to you and your teams and families, very happy 2024.
Same to you.
Thank you so much.
Thank you so much.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.